Welcome out to another Trading Justice podcast. This is Mark Justice, joined with my brother Matt from Tackle Trading, and we're going to have a real fun time and a fascinating technical battle, fascinating market conditions. This is one where all of a sudden, even passive investors all of a sudden are really keenly tuned to the market right now. It's like, I'm going to check my quarterly statement every 3 months, and now I'm tuning in every 3 minutes to the account. We're going to break it all down for you. Tackle Trading, amazing community. You want to be a part of it. You want to learn technical analysis. You want to be part of this community. We help navigate our community through all kinds of market conditions. We've been on a volatility plus mindset for this entire way down. Being a member of this community has helped every part, from coach to new members to experienced members. You can join right now. 15-day trial, go to tackletrading.com. And part of that pro membership will be your ability to attend our Master Trader, our Master Workshop coming up here in a couple weeks. Tell us a little bit about the Master Trader, Matt, before we get to dive into it all.
Yeah, this month's Master Trader class, 24th and 25th for the pro members. So if you are not a pro member and you want to come and get some of the best education you will ever have from a trader's perspective, learn how to trade from a technical perspective, learn how to read charts, learn how to trade options, you name it, come join us in Master Trader later this month, March 24th, 25th. It's a 2-day course, 3 hours a day. It's going to be way fun. On demand comes with it. So if you're not a pro, come join us.
Yeah. Right now, one of the nastier stretches we've had in markets for bulls for some time, and it's set up fascinating dynamics. I'm going to give you my high-level market, perspective here. It's a train wreck from a macro perspective. I think the bears have the clear case, but we have seen some insane put buying in the last 5, 6, 7 trading sessions. Like you shared a stat the other day in Tackle Trading that there was a record amount of put spot on the Qs.
On Thursday, it was third highest put buying on record was Thursday. And that, whenever you see something like that, the contrarian mindset really.
No, and it's not just because I'm a contrarian for the sake of contrarian. We have seen those similar conditions.
The previous two put a bottom in the market and
let alone stop.
It's not just contrarian. There's historical data.
There's mechanics on it all, Matt.
Mm-hmm.
Like when people,
once support starts holding and the market starts going up, like those shorts, they have to do it. They have to start covering their short. And that drives the market back up, and then you start having a little bit of a short squeeze. And then, and quite frankly, oftentimes when you see this level of put buying or this level of call buying, either side of the ledger, it's usually late stage, right? And so you see this late stage because all of a sudden this information of the volatility of the market and the concern of the market and so on and so forth is breeding, right? Think about it like this. You said something very in your intro that was very interesting to me. You said the passive investor is waking up to this. Mark, just last night, I get a call from your mother.
Wow, what a shock. She gave me a call too.
I'm not surprised by that at all. She probably called.
And our mother is the definition of a passive investor.
Absolutely.
She does 100% does not care. Just likes her account, grows up. I mean, I haven't gotten a call from her for years.
No. Well, I get one. Okay, let me put it like this. I got one about 7 months ago when the market was spitting up some volatility and it was puking up during that earnings season. And I got a call from my mother back then, and my mom said, "I'm worried. What should I do? What should I do? Should I get out? Should I get out? Should I get out? What should I do? What should I do? I'm really concerned. I'm really worried." And I said, "Mom, do not call me again on this. I will call you when you have real reason to be concerned, because there's real things in the market and there's not real things in the market." Mm-hmm. And when you're seeing a market puke up based on NVIDIA earnings 7 months ago and technology's driving down, but not everything is selling down, not everybody understands the context of that RSP versus SPY conversation and so on and so forth. So I said, "Mom, I will call you when you need to be worried." So she calls me up yesterday and she says, Should I be worried? Should I get out? Should I get out? Should I get
And
out?
I'm fascinated because Matt and I did not discuss this before the podcast.
No.
So I'm fascinated what you told me. See if
I did assume mother called you as well, but she calls me, she gives me her wall of worry, and I said, listen, this is not the time after a 10% drop in price to capitulate to the fear of the moment, Mom. You have to be a little bit more constructive than that. And we have to be a little bit more systematic than that. And I said, we are currently overextended to the downside, going through one of the most chaotic moments in market history, in recent history. And what I mean by that chaotic moment is a lot of information is coming into
things have been changing very fast.
A tremendous amount of information. That some of it is a one-time volatility event. Some of that is other, obviously a little bit more than that, i.e. the tariff conversation. But I just felt like it was too soon to have that overall market conversation when over the last 5 years, we're talking about massive growth. And I don't think it was wise for a passive investor who still has 10, 15 years of investment in front of her to really give too much concern here. What I said was, listen, what we're going to do to alleviate that concern is after the market rips higher, we're going to add some insurance to the portfolio. I'll call Tyler. We'll make sure to do it. That's what I said. What did you say?
Yeah, similar.
Wait for the sell to rip and then add some insurance.
Yeah, and this is someone. Hello, my name is Mark. I'm a bear, and I'm going to have to be proven wrong. I came out on the podcast a few weeks ago. Like, I'm bearish. Like, and that was exactly my
I want to be very clear. Mark went bearish on the breakout candle.
Yes.
He did. He called me up. He says, I'm fading it. We talked about it the next day in the lounge. Like listen, you're doing your big short on this one. I don't know if you're going to have the courage to hold through all of it, but you got a little bit of a big short going on right now.
No, I mean, and I made some tactical mistakes because I didn't expect the speed of the drop. But I've been bearish, continue to play bearish. Will have to be proven wrong.
So
but
what
that
was your advice?
Almost similar. I'm like, this is not the time. Like, and that is from a bearish perspective. I'm like, you do not capitulate in this environment here. There's too many things. And I told her to sell the rip. Now, I didn't use the word sell the rip because she wouldn't understand that, right?
I did say that, sell the rip to her. She did not understand it. She says, what does that mean? And I said, don't worry about it. I'll call you when it happens.
You know, and so it's one of the things. And when we get to the coach's corner at the end of the podcast, there were several questions. And you can imagine, should I buy puts here? What should I do here? Like, listen, type things.
Our mother is a passive investor, but she's no different than a lot of other people that have those exact same questions and concerns right now. When the mother is calling up the trader saying, what's going on? This market volatility has seeped out of just the trader.
It started to reach Fox News, CNN.
It's not just the Wall Street conversation. It's on CNN, Fox News. It's on traditional media.
And of course, they're all attributing all of the volatility to tariffs, and tariffs have certainly played a large role. But Matt, before we get into technicals, for me, this is, yes, are tariffs exacerbating the situation? But my bearishness, like when I went bearish, Matt, it had very little to do with tariffs. You know, that was a component, right? And that is the headline, and that's what everyone gets. But I think there's some structure. I'll just fire through a few of these, but it really involves around growth, right? The growth worries, right? The uncertainty around the administration, tariffs being one aspect. And to be honest, Matt, the number one thing that I am bearish on is the administration itself. Not because, I don't like Trump. It's because the administration is making it clear that the market is not their priority. In fact, I thought one of the most bearish statements out of an administration I've ever heard was Scott Bessent, the Treasury Secretary this week, where he said, listen, the market and the economy have been hooked. There's going to be a detox period. Janet Yellen wasn't talking like that for the last 4 years. No, it was the previous Treasury Secretary. She was out there. I'm concerned. And when she was concerned, markets went up. Like, right? Scott Bessent is telegraphing a different vibe.
He is. And don't get me wrong, like if Bessent would have said that 3 years ago, we're talking massive market volatility. I'm not sure the market is puking up what he is saying. I think it's the uncertainty of the environment that the market is really struggling with. I'll say it from my perspective. I actually really enjoyed what Bessent said on that, because when you look at the last, not just 5 years, I mean, everybody goes back to 2019 on the spending conversation with the government saying, we need to go back to pre-pandemic spending, right? Pre-pandemic spending. And I'm like, okay, we can have that conversation, but Bessent isn't just talking about that. Bessent is talking about quantitative easing, modern monetary theory, and this philosophy of modern monetary theory that has seeped into the central bank and the government, not since the pandemic, but from the subprime meltdown on. This is a macro conversation that he's talking about on the modern monetary theory side, saying, listen, the U.S. embraced modern monetary theory from 2008 on, from Ben Bernanke in 2008, embracing quantitative easing, corporate bailouts, and free money parade. Basically, from that point on, we were addicted to the concept of quantitative easing, low interest rates, and that was the driving force of the entire marketplace for 10 consecutive years. And then you had the pandemic, where you had massive government spending in the immediacy of the pandemic, and then we continued that spending habits after the pandemic. And so from 2008 to 2025, we have done nothing but continually spend more and more and more. And so what Bessent is talking about is not just the simple philosophy of, oh, we're not going to save the party here. I don't think that's what they're talking about. I think what he's talking about is we need to detox, and I did appreciate the choice of words there. We need to detox from the concept of modern monetary theory. But if he says it like that, nobody understands anything he's talking about, because people don't understand what modern monetary theory is. And quite frankly, we do need to detox from the concept of money having to only provide growth. Additional surplus of money is not the only way to drive growth. It's just been that philosophy that it got adopted. And this is a Wall Street philosophy. It got adopted at Wall Street in 2010. It's been a driving force since then. And so I for one, appreciate Scott Bessent, who is talking about these macro things, because we have to battle modern monetary theory. Modern monetary theory is a disastrous monetary philosophy of free money, zero recessions. And ever since then, we've had some of the biggest upwards movements in price and downwards movements in price. And it goes back all the way to Greenspan of the market cycle and so on and so forth. So I appreciate what Bessent is talking about on the battle against modern monetary theory. And I think it's extremely important that we get fiscally conscious and fiscally responsible as we start embracing the AI conversation downstream here. Because at some point, Mark, we are going to have a UBI conversation in America in the next 10 years. And we cannot have that conversation with how fat and bloated we are from a federal government perspective. We have to get efficient. And so growth, and again, I just want to be clear. I believe we had some ridiculously historical growth opportunities in the 80s and 90s, and it wasn't based on fiscal surplus, monetary intervention, quantitative easing. This philosophy was born in Japan in the 1980s and 90s. It fostered the philosophy in the early 2000s in the United States. It was embraced by Bernanke in 2008. It was fed through the central bank monetary system through debt explosions and monetary surplus and intervention on the quantitative easing side for 15 years. It is time we do get effective and efficient. And so I guess my perspective on that, just that Besant conversation, is I do find that to be very important for us as we move into this next stage of the currency cycle. And so I didn't take it as a negative when people are talking about efficiency. I don't take it as a negative when we're talking about cutting waste, fraud, and abuse out of the federal government, because waste, fraud, and abuse doesn't go to massive growth opportunities. Waste, fraud, and abuse goes to a select minority.
They may
group.
be good long-term policies. It's not going to stop the S&P from hitting 4,200 later this year, right?
I disagree with that.
I
don't think the market needs constant reinforcement, constant monetary stimulus just to survive. I do not believe that.
At these valuation levels, I disagree entirely. It absolutely does. This is where the valuation.
How are we going to make that argument when we have went through interest rate increases over the last 3 years, and the market was at an all-time high just 2 weeks ago?
Janet Yellen juiced the market for 2 straight years. You take away the juice, you're back at the levels where the juice started. That's around 4,200. So listen, I applaud Scott Bassett as well. I believe that these are the correct.
I just cannot agree with that. I cannot agree with the fact that that if we try to get effective and efficient from a federal government perspective, that automatically means the market goes down. It
doesn't automatic, but you take away the government spending, that bleeds into earnings, that bleeds into the economy, that bleeds
government
into
spending. We're going to have the exact same fiscal policies this year that we had last year. They're doing a reconciliation bill. Like Reconciliation Act is basically taking the.
Well, if they do that, then interest rates are going up. They're in a no-win situation, in my view. Like if they do not curtail the spending, yields will go up. You'll hit 5, 6, 6.5%.
So let's curtail the spending.
The market's in checkmate, in my view. Right now, I still don't think this is the time to go back. And that comes down.
I think we have to figure out the differences between real conversations on the fiscal efficiency side and what they say for Twitter and X and social media and getting kind of the base up. I think we got to be able to differentiate between those two things, because again, I will never see any aspect of an efficiency conversation as negative to the growth side. I will not see that. You cannot make an argument on an individual stock that if that individual stock is going to get more efficient, that they're going to go down in price. A stock that goes through efficiency goes up in price. They go up in price because profit margins.
Costco's a pretty efficient organization. They gave back some of that juice.
Listen, I get it. But if you can, Mark, if you can produce the exact same amount of goods with a lower cost, your company is going to go up. And if the United States can produce the exact same amount of economic value, but with less overhead, you're going to see a growth argument there. And so I don't think it's just as simple as saying federal government, we're going to see less fiscal policy, and that's automatically going to see the market go down. Maybe not.
The Trump administration needs to hire you as a spokesman, because you articulate the general argument better than anyone. They have a terrible communication message right now. It is causing uncertainty in the market. The market right now is like, what is the plan? Is there a plan? They went from, yes, tariffs are a negotiation to JP Morgan this week, might have been Morgan Stanley. They had a great statement. We saw tariffs as a negotiation tool. It appears that we were wrong, right? And I think there's a lot of that going on Wall Street right now, where they viewed the Trump administration one way, and they're starting to think this is not the same Trump from the first term.
Well, but that's not what I'm talking about. Mm-hmm. I'm talking about the government getting fiscally effective and efficient. And I'm saying that is not a negative growth argument.
I agree for the long term.
That's what I'm saying.
For the long term.
I agree with you that the tariff conversation is creating concern in the market. 1,000%. I have 2 eyes and a beating heart. Yes, we can see that. But again, is it a short-term problem or is it a longer-term problem? I guess is the
Well, it
ultimate.
depends on how you define long term. Like if if you and I are sitting there in our older age and we have gray hair,
Yeah, that's
efficiency
long-term
leads to a
problem.
more robust. Tactically in the stock market, I will be a bear until I see it, right? But it's not right now because of some of these like if you are bearish, it is no different than being bullish. You don't get greedy and you look at opportunities that might be a good opportunity to make some money on the bear side. In my opinion, this is not one of them right now.
Yeah.
For two reasons. All of this put buying that just smells like it's going to create a counter rally coming up. And you are coming in, and this is very important to me, to structural support levels, right? Structural support levels, and this is where go attend that master trader class, be part of tackle trading. Structural support levels tend to put up a fight, right? It's like you're a bull, and I'm going to go really bullish into resistance. We're going to look at a gold chart right now in a few minutes. Probably not the greatest time to go super bullish when resistance is overhead, right? You wait till that resistance breaks. It's no different on support from a bear perspective. Probably not the time to panic, give those structural support, a chance to work. Probably not the time to go get super uber bearish either. And you talked about the bearish retracement. I think you named the podcast The Battle at the 200. In the newsletter this weekend, which I always enjoy reading your technical perspective, you talked about this situation. Break down the technicals, which are really, as we debate Scott Bessett and this and that, the story this week is the technical battle here.
Yeah, and to the previous conversation, you and I do not disagree on the short-term concern at all. At all.
We're both in the sell the rip camp.
I am right there with you. I guess I'm willing to give the administration a little bit more leeway on the efficiency side of the equation, because I do believe that is very important for us to get dialed in. We can't keep on going into more debt and more debt and more debt and more debt.
Yes, everyone knows this.
That can't happen. And I'm not breaking any news there.
No.
All right. So in terms of the technical conversation, basically what I said in the newsletter in a nutshell is there's two things that are really, really, really important to understand in this current market condition. The first being the levels of where you expect these battles to ensue. And the 200-day moving average is a very, very important one. That is the 200-day moving average is an investor battle zone. It's a trader battle zone.
Some of the greatest battles in the last 30 years have happened at the 200-day moving average.
100%, because you get underneath that 200-day, it gets really choppy, and you start thinking about anything to the 200-day. You're thinking short-term issues, correction. Type of correction.
Matt, when we broke the 50-day moving average and filled it into the 200, that's just technical analysis. You fill space.
That was a high probability of occurring once
you just fill space. Now, it happened faster than I thought you would, but the fact that it happened.
When the bulls stop fighting, this is what happens. But in terms of that battle at the 200-day moving average, this is one of those zones where you're going to get a lot of dip buyers coming in who didn't participate in previous runs. You're going to get traders coming back in to support. You're going to get investors to support. For example, you got take Amazon, for example, sitting at the 200-day moving average, tried to breach under it on Friday, recovered back up to the 200-day moving average. That's a magnet at that 200-day moving average. And so obviously you expect battles. So that's number one. Underneath the 200-day moving average is very important to understand here as well, because when you go back to previous examples and previous case studies of where we tested that 200-day moving average, there's not a lot because the market doesn't test the 200-day moving average all the time. But when you do go back in the past and you look at some of these other moments in time where it did, for one reason or the other, market gave up its trend. Now you're starting to talk about a correction in the market, and you saw that come into the 200-day moving average. And what happened? You had a battle at the 200-day moving average initially. You had that basically sell the rip environment, right? Where you have the bearish retracement come back up, it pivots, turns around, gives up, and then sees that next leg down. And then what occurs here? You live underneath the 200-day moving average, fight back up. And then once you get back up above the 50-period mark, it was a really, really, really good trending environment, but it went through multiple stages of pattern.
Yeah, that's where Janet started, and Jay and the pivot.
And if you don't think that's not going to happen
it is going to happen. Listen.
Okay, so we can talk about,
we just don't know when.
Responsibility, but something's going to happen if things get out of control there. But you'll go back in time to the last time we did that same song and dance. You kind of hit that 200-day moving average, and guess what? 2-day rally up into the 20, big rally. First test against the 200, big rally. Then you had a subsequent test down, and you basically finished underneath the 200-day moving average, finished for about a week, fought back up, and then what occurs? You break back up above the 50 and get into a consistent trending environment. I can go on and on of recent test against the
and not just recent, Matt, going back decades.
It's very common. And so when mom called me, I said, listen, wait for the sell to rip, because when you look at those last couple case studies against the 200-day moving average, both of them went back up and tested the 20. Both of them came back down, established a low. Both of them then figured out how to do a reversal. And so basically what I talked about in the newsletter was zones and patterns. What are the important zones, and what is the pattern recognition we need to see at those important zones for the bulls to get back up into some degree of control against the price action? And so, Mark, yes, I think there's a fairly decent probability that we are going to see a little bit of a counter rally. But I see that counter rally as bearish. I see it through a bearish lens because we are in a bearish short-term trend. And so I see that through the bearish lens. But behavioral analysis when it comes to technicals is extremely important, because one pivot on against a bearish trend, you see it through that bearish lens. But if that pivot therefore holds on the next test, you don't see it through the bearish lens. You see it through a W or a bullish lens. And so pattern recognition is going to be key here. I think patience plays, no doubt about that. I think eventually coming out of this, I don't believe this is the starting point of a massive recession. I did see the probability of Goldman Sachs go up to like 35%,
let's because I want to come back to technicals. I want to talk about this point real quick, because one of the major things in the market has been the sudden worries about growth. Atlanta Now GDP, all of a sudden in their last couple forecasts, projected negative GDP growth. We had services go into contraction a couple Fridays ago. The combination of those all of a sudden have created growth worries in the market. Now,
I think in general, that's the concern on the consumer.
Yes. Right. Yeah. And growth worries are a funny thing, because they're there until they're not, right? And if you start to see economic data, and this week, and it's important to understand, not only is it the technical point where I am becoming tactically bullish from a credit perspective, if you will, certainly not getting greedy on the bearish side, waiting for better opportunities. But bears have a long history of screwing up because they bet on Armageddon, and when Armageddon doesn't come, they have to pay for those puts in a big way. And all of a sudden, this
chase volatility, and the volatility is high, and you're chasing, which means you're buying high volatility, and you're buying after an extended move to the downside. On the put side, right?
Yes.
And again, maybe the floor falls here, and it just caters.
And this week, Matt, but manufacturing data continued into contraction. That services data that showed contraction was actually revised up into expansion. Yeah. ISM services had a healthy beat, like there's nothing wrong in the world
this week.
Unemployment report, while it missed fractionally, still showed decent job growth. Jay Powell was out there helping cause
there was people on the labor market numbers the day before the labor market numbers saying we were going to get negative numbers.
Yeah, the economic data this week.
We are having this conversation in general as Americans is ridiculous.
Yeah, and all of us, yeah,
Mark, I saw it on Fox News. I saw it on CNN. I saw it all over the board. Political shows, not economic CNBC, political shows talking about how we were going to get negative jobs data the following day. This was on Thursday night. Friday, we got 151 against 158. Nobody's even concerned on that side of the equation. We're having a conversation as Americans that maybe not be manifesting itself from an actual
Matt, the economic data this week was a huge, massive win for the bulls. Armageddon postponed. Armageddon postponed when you match record put buying at key support technical levels smells counter rally here.
It does. And again, long-winded way of saying wait on the sell the rip environment if you're thinking about it from a bear perspective.
Yeah.
On the bull side of the equation, I think you're still in volatility playbook. You're certainly looking at the low point, trying to take advantage of a sell the rip kind of rally, counter rally here. But you're like I was talking to the team on Thursday in the lounge. I said, guys, swing trading right now, because we have a lot of swing traders in our community. It's either one, you gotta shorten your time frame or you gotta extend your time horizon, because you can't sit in that standard swing trade. The price movements you're getting in the market are 1 to 2, 3 days here. Like that's
I love how you said that. You're either you're in and out really quick, or you're giving it more distance. Like that swing trade, that is stuff you get at our Delta Dogs trading lab. That is great advice from an expert swing trader right now.
You have to, and I say this all the time. You can't force your will on the marketplace. You have to be willing to adapt to the current volatility of the market. And right now, that's a day trader. That's a day trader's environment right now in the marketplace. As we see patterns develop here, that's when you start to feel a little bit more comfortable on extending your time horizon as a short-term trader. But as of right now, I just don't think a lot of traders have a lot of confidence to carry overnight.
Yeah, no, and so it's one of those situations, and we'll continue to break down the thing. The one thing, Matt, and I want to look at NASDAQ versus RSP. One of the things that, the next wave of bearish opportunities, which I don't think are this week, we'll see how the market plays out, are not in growth, right? Growth is where the brunt of the carnage has been. And if you think this is all about tariffs, I want someone to explain to me why Mag 7 and growth stocks are adversely impacted by tariffs compared to other areas of the market. Like, how are they the one?
Far more traditional pricing here that is similar to more pre-pandemic stuff, Mark. And what I mean by that is in 22, 23, the defensive nature of the market changed a little bit, and Mag 7 started getting fear bids, correct?
Mm-hmm.
Okay. That wasn't the case before the pandemic. Before the pandemic, when fear hit the market,
growth had got hit
staples,
first.
Gold, the traditionals, right? Food-based companies, healthcare companies, these consumer defensive type names. We are seeing that right now play out a little bit more. For example, Mark, you talk about the growth areas taking a hit recently. Well, what's offset that? Well, obviously not in the market, but consumer staples has had a really good trend all the way back up into the high price. Healthcare is starting to shore up really well. Real estate looks pretty decent right now. And so, we've seen rotation from a very aggressive sell program in the aggressive areas of the market, stabilization in defensive, if not upward movement in price in defensive, and cyclicals all over the board right now, like all over the board right now. But on the Q side of the equation, what happened last time we spent one day underneath the 200-day moving average? We had a 10% rally. I think chasing here on the bear side is a mistake.
Like if it works out, you get lucky because it's not a historical tactical.
I can just tell you how I'm seeing it. I'm seeing it. Yes, I see it through a bear lens, but I am trading bullish positions coming in on Monday and Tuesday.
And that's the thing on the bullish credit side. I have not been afraid of bullish credit from a tactical
I think bull
perspective.
credit plays here. Yeah.
And this is the thing about being a trader, right? You have your macro belief. I do believe over time in the coming 18 months, markets are heading lower. That is my belief. And I will lose money when the bearish opportunities arrive. But that doesn't mean it's just like being in a bull market, right? You trade to the bullish side, but you look for opportunities on the bearish side as well. I think we're in one of those moments
I
where,
do too.
where you can find
I think there's good
opportunities,
bull stocks that are setting up right now.
where you can
And I think
find
that
opportunities to make money on both sides of the equation. I'll tell you what, Matt, on Friday, my sold calls and my sold puts made money.
yeah, yeah.
I had a good day on Friday.
We finished inside candle on
inside candle. Both sides of the equation were up.
You finished inside candle. The credit trader is going to be happy. Yes, that is the case. What I'll say, I think the first of next week is you're thinking bull because of the overextended nature and the philosophy of a counter rally. I think you're thinking bull. But I do believe we're in a short-term bearish trend here.
Yes.
And so understanding how the market behaves at resistance levels is going to be key as well. Mark, the last two times the Qs tried to punch up, it got smacked by the 9 EMA, absolutely destroyed by the 9 EMA. And so when I'm talking that counter rally, like, yes, you're first looking at that counter rally to the 9 EMA. And then you start talking about if you get back above the 9 EMA, you start talking about the deeper levels of the equation. We're not going to be talking about a bullish trend until we can start talking about the 9 EMA.
Oh, the bulls have a long way to go before you're looking more than tactical windows. And so, like, on the way up, I'll be reducing my bullish plays, won't be looking for new ones, and I will be looking for classic technical patterns that we teach in Master Trader, that we teach in Tackle Trading on good old-fashioned bearish retracements. They happen. They're glorious when they do.
Honestly, the first pattern that develops in any scenario on an overextended is a bearish. On an overextended short-term trend to the downside, bear trend, the first pattern that develops is a bearish retracement. If that bearish retracement does not violate the next level of support, we're talking reversal. That takes weeks, not days.
Yeah. And so it sounds like you and I are seeing this situation the same
overextended bounce going
other than your raw American exceptionalism. Scott
I do believe in American exceptionalism. That is accurate. Yes. In my core, I believe in American exceptionalism. Yes, 100% I do. And I'm not
that hasn't been
I am unapologetic.
I know, yeah, you're such a I will red, white, and bluer
United States until my last breath is taken. Yes, that is accurate.
I know my brother. Give me K-Web. Because let's get to global markets here. I don't talk about Chinese stocks very often, but they had their 2 sessions meeting, which is their annual meeting this week. It's a significant meeting. Is K-Web not pulling up?
Okay, yeah, the international ETFs. Toss does updates on Saturday mornings.
Give me copper then. Might as well, in copper, you might as well talk China anyway, since they're the same darn thing most of the time. Now, lately, that hasn't been the case because Trump's included copper in the tariff conversation, which copper's acting like a meme stock right now. But China had their big, meeting. And while United States is going through their own heavy news flow, the international stuff is quite dramatic right now. China is pumping money. Germany basically came out this week and said, we're going to spend however much money we need to, which has caused German bond yields and a lot of, French bond yields to actually go parabolic. Pretty crazy, actually, on that. And we're seeing really dramatic movements in currencies, Matt. We're seeing this is not boring markets right now, to say the least. And the dollar looks like it just announced earnings and lowered guidance 80%.
That's a good call out. We're looking at FinViz here, heat map. And when you're looking at kind of what you're talking about, Mark, is the U.S. markets have been puking up over the last 2 weeks. It has not been a global market.
This is, yeah, I mean, because sometimes you see
And
risk on, risk off, and it's all.
hence why I also don't believe this is the big bear, because global markets are connected.
Yes, that
And
liquidity flows through the system.
100%. And so when you're looking at, say,
That's a good point. I didn't even think about that.
the international markets have been the benefit of the money coming out of the US markets. And that is a direct reflection of the tariff conversation. That is a direct reflection of the tariff conversation. How far that tariff negotiation / policy goes will have a long way of what we're seeing on these heat maps 3, 4, 5, 6 months from now. But it's not like in the last 2 weeks in the stock market in the United States, we're seeing an all sell everything moment in the United States. We're not seeing a global market meltdown. We're not seeing any of that. We're seeing aggressive areas of the market that have done really, really well puke up. We're seeing a lot of that. We're seeing cyclicals get beat up pretty healthy in the United States. But you look at China over the last, and again, let's take it outside of a week and let's look at, say, the last month. You look at the last month, and again, you come to the United States, and in the last month, what are we doing? Mark, in the last
those are some big numbers.
Yeah, but where's all the big numbers? It's not like it's a big Red Sea here. It's very mixed. When you look at the heat map, I don't know how you come away with saying anything other than mixed. When you look at the trend of the SPY, not mixed. Bears have had a moment. But we haven't seen, I know it feels that way. And that's why when I hear people talk about the big bear and the end of the world and blah, 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 and I'm like, but Berkshire's up at an all-time high. Healthcare is starting to produce. Comms just needs like 2 days of recovery, and it's still in a bullish uptrend as comms. We have utility.
You know what that chart looks like to me? Where was heavy positioning?
Exactly.
Walmart, Costco, JP Morgan, UNH, all of the mega caps.
NVIDIA, Broadcom, all of the semiconductors.
Where did people get too greedy?
Crowded areas, Mark. Crowded areas. And so when you're talking about the big bear, answer me this, big bear. Why are we seeing international markets go up? Why are we seeing a mixed market if this is the starting point of the end of the world from an economic perspective? We are seeing areas of the market that had high valuation start to crater against price action. We're seeing a lot of volatility.
Yeah, I was tactically bullish before this podcast. You're increasing that a little bit. This is an excellent point, right? The combination of the world markets and this heat map, that only looks like a crowded positioning map.
And Mark, a lot of the issues on the heat map on the international side are things that have impact in the U.S. market.
Yes.
You take Ireland, for example, ETN, JCI, ACN. Those are big time names for traders in the U.S. stock market. In the United Kingdom, bro, look at all these here. ARM. ARM is a massive component in the U.S. markets on the AI side of the equation. You want to take a look over here in China, Japan? Well, where's the problem? Taiwan, which is a massive component of the U.S. markets. You want to take a look at Luxembourg? Pretty green, except Spotify, a massively popular company in the United States. And so even on the international side, the biggest stocks that are getting beat up, like Canada stocks getting beat up, obviously a little bit of the tariff conversation there as well, but Shopify, CNQ, Lulu, all big time traders names in the US. So again, I'm not seeing a global market synchronized where it's just a sell program because all of a sudden every nation around the world is going to stop spending money and we're all going to be fiscally conscious here.
Between the economic data being solved, this obviously being a positioning issue, the extreme put buying coming into structural support, this is a good tactical bullish case. It really is. Yeah.
That's why I keep coming back to, and why I answered our mother that way last
And
night.
why I,
Not the moment. It's not the moment technically, and I don't believe it's the moment fundamentally. I do believe we're going through, obviously, you don't get to the 200-day moving average without going through some shit. Okay, that's the truth. But I I believe pattern recognition is key here. I believe there's a buying opportunity that results out of this volatility. And again, I think the differences between who's going to be proven right on that conversation, you or me, is dependent on a couple variables moving forward. Obviously, there's some concern economically, but I think pattern development here is going to be extremely key.
yeah, absolutely. Let's go look at gold real quick. Gold has been the most boring instrument, but the most fantastic cash flow instrument over the last month. I cannot rave. I've been selling a little bearish credit on gold, Matt. I've been selling more bullish credit, but it has been fantastic. Nothing burger for the last month.
I got
Uh,
this as a cover call environment. Like
yeah, like
I I love gold. It's one of my favorite instruments in the history of mankind. I've been, but we had a really good run, bro. A
yeah.
really good run in gold. And now you're kind of dialing in some overextension here, and the dollar's overextended to the downside. I think we're in some consolidation. And a lot of that is because of this strength of this move here. It was so strong and it was so consistent. I wouldn't be
This
surprised.
feels like you're going to consolidate for a while.
It does. It does feel like we're going to consolidate. Now, that's on the gold side of the equation. And again, Toss is running some updates, so I can't get charts outside of the indexes here. But when you look at GDX still has a potential to catch up, even if gold simply consolidates. But gold needs some moment there. Good covered call environment, good cash flow environment on gold. Just too tight against resistance and need to see some consolidation breakout analysis.
Now, in the midst of it all with Bitcoin this week, and then we're going to get into some bracket funness for a few minutes. Big interesting week in Bitcoin last Sunday, and in these markets, like last Sunday feels like 8 months ago. But last Sunday, Trump was out there pumping crypto on Truth Social. I was going to start the reserve, and he loves crypto. And futures shot up. We're up like 10%. And then Monday started, markets volatile, gave it all back. But then some excitement built during the week because you had the White House summit and this big promise. Well, Trump on Thursday night, and I have believed in this very, very simple theory that if the United States government is going to be purchasing Bitcoin, I believe the upside is unlimited. Now, you and I disagree with that, on some levels. We'll have that debate another day, but that's been my narrative, not a complicated narrative, and a lot of people shared that. Well, on Thursday night, Trump came out, signed an executive order creating the strategic Bitcoin reserve, but in that stated the United States will not be purchasing any Bitcoin, that they'll use to fund that reserve through already seized assets and future seized assets, and put it confiscated in this little kitty. And then you call it a Bitcoin reserve, which to me is just marketing. It has no meaning to it at all. It's like it's a reserve, even though we're not doing anything different than we already are. We're just not going to sell them. We're gonna hold. I hated the announcement, like with a mortal passion, because it blew up the narrative.
Well, so did the
Right?
market. They sold the announcement.
They sold the announcement. Now they've tried to do some backtracking from that because some people have whispered that, hey, they don't like this, and like, oh, we might
Well,
look at some future purposes. This turn for me, I am no longer bullish on Bitcoin. I am tactically treating it like any other instrument, which means I'll do bullish plays, I'll do bullish credits when the pattern's there,
yeah.
but I'll just treat it like another chart.
You are right. I don't have the same philosophy on the United States government buying Bitcoin, and all of a sudden that means Bitcoin's bullish. I think that would basically destroy volatility and velocity of money. And when you have zero velocity of money, you have no value, like, at all. Mark, if I have $1 million, but that $1 million is parked in a bank account and never does anything, there's no value to the $1 million. It's nothing. It's just a currency. And so I do have some disagreement there. There is no doubt about that. I think the flaw in the announcement on Thursday was the lack of additional purchasing at a Bitcoin, additional purchasing of Bitcoin, because what they're doing, at least on the initial announcement, was the United States government owns 200,000 Bitcoin. And how they got that 200,000 is they confiscated it, and they confiscated it through illegal transactions and so on and so forth. The Big Silk Road documentary and whatnot from 10 years ago or so. And so they have 200,000 Bitcoin. And what the announcement on the reserve does is that it allocates that 200,000 Bitcoin, but does not purchase any more Bitcoin. And then they are also going to do two things, and this was clarified over the next couple hours after the announcement, was they're also going to look to reinvest gains of any asset class. And so as Bitcoin goes up, they're looking to reinvest those gains. That's an if, by the way, not a, like, if it goes up, they have gains type thing. So they're looking to reinvest gains, but what it lacked was any plan of the U.S. government actually passively purchasing Bitcoin in general. In fact, on the announcement, they made a point of saying they weren't going to do that.
And no, they went out of their way to say that they're not doing that.
They stated, we are not going to take United States taxpayer money and buy Bitcoin with it. They made that statement because they're very conscious about the efficiency of the taxpayer money right now, because let's face it, they're firing a lot of people because of that efficiency argument. And so they didn't want to do that. That obviously was a flaw. And so they came out and they tried to clarify the statement and say, well, we are now going to look at the Treasury Secretary and the Commerce Secretary, Lutnick and Bessent, and they're going to look at finding alternative ways of purchasing more Bitcoin. That's not a plan.
That's not a plan. That is,
Not a
this
plan.
is the problem the Trump administration has right now. I think they have some good.
They act like they're running an election and not running the government, Mark.
Yeah, and, you know, I think they have some good philosophies, right? You and I both lean to the right side, the conservative side of the thing. There's a lot that's going on that we agree with, right? Just from an ideological perspective. But the way things are being communicated is like
listen, saying to somebody, we are going to look at finding alternative ways of purchasing Bitcoin 14 hours after saying we're not going to be purchasing Bitcoin, that's not a plan.
I don't trust you anymore. And like, this is just from a Bitcoin enthusiast narratives. I hear this communication. I have zero faith in it. And it's one thing if the asset class wasn't up 300% in the last 2 years, right?
Well, and I honestly think that too much was made of making this a reserve in the first place. And so I get why all the Bitcoiners either happy or sad today. But to me, it's like they already had the 200,000 Bitcoin. Like there's
we're just labeling it a reserve.
Yeah, like
that's cute.
Doing analytical, and it's like, okay, what's new? What's changing? What's different? There's nothing here. There's nothing there. There wasn't anything last week. There's nothing this week. Price action last week was at 85,000. Now we're at 86,000. And we've had all this chaos over the last week of crypto announcements versus non-crypto announcements versus reiteration versus updating. And it's just like, why don't we just sit down, write out a plan, and release it as a policy statement? Like, white papers are there for a reason. They are there for a reason. And so I just thought this was really, I like I said, I'll give them a lot of credit on the efficiency side of the equation. I thought this was mishandled. I'm glad they came out and tried to clarify it, but I did think the announcement was mishandled.
Yeah, less flying by the seat of your pants.
I think it was mishandled because David Sachs basically, as Bitcoin was selling, went to Trump last week and said, we got to do something. We got to do something. We got to do something. All I'm going to say is, where's our stock version of David Sachs in the Trump administration? We are missing that, because the reason that announcement came out last week is because of the week before we broke support and went down 20% mark. That's why that announcement came out. That's why David Sachs went to Trump. That's why the announcement happened last week. And so it came out haphazardly because they did it because of the market volatility the week before. All I'm saying is give us that same thing in the stock market. That's all I'm saying. Give us a little bit of cheerleading is what I'm saying.
The market is not in the mood for this. Oh, let's give you a little bit. No, we need clear communication. And all I know,
and rinse and repeat that same thing on the tariff conversation.
whatever you're gonna do it. That's fine. Just let us know.
With the market is the ability to price in the future.
That's the thing. Like whatever you're gonna do it.
It's not it. Like people want to get into the pro-tariff, anti-tariff. From a market perspective, it's not pro-anti. It's pricing power. Tell me the environment, and I'll tell you what the natural price should be. That's difficult to do right now. Obviously, as we get that clarified, maybe it does.
All right, what's going to be difficult to do is picking some of these bracket winners. I've really enjoyed the Stock Madness contest that Matt created. I think it is a lot of fun. I know within Tackle Trading, we have a lot of fun debating these things. I know I have a lot of internal fun debating these. And we got some interesting round 2 matchup. A lot of chalk, few upsets, but nothing terribly surprising. Oil lost. What a shock. I think oil would have lost against, pick your random meme stock. But some interesting round 2 matchup where things get a little more difficult. And if you don't know what this is basically a NCAA March Madness bracket where Matt has taken 64 stocks or asset classes, seeded them, and they do battle. And the winner is decided by who you would invest in for a 2 to 3 year time period, approximately. Like if you had to put your money and say, nope, I'm investing in this for 2 to 3 years, who would you pick? Matt, some interesting round 2 matchups as we're down to 32 asset classes. Talk about some of your favorites.
Yeah, let's kind of recap round 1 very quickly. The AI Gold Rush bracket here, NVIDIA beat Snowflake. That's not surprising. Palantir destroyed ASML, not shocked. Meta and AMD had a really good battle, 52 to 48. Meta did come through. Alphabet, ARM Holdings. ARM, I thought maybe ARM was going to be able to pull it off. I did actually vote for ARM on that one. I voted for Meta on that one. I went NVIDIA, Palantir, Meta, ARM, Taiwan, Amazon, and then I went with the data dogs. I was one of the Delta dogs there, although there was some bias there. I actually think Broadcom is probably a better company there, but not a lot of surprises in the AI Gold Rush bracket here. Round 2 matchups, very interesting to me. One of my favorite matchups just so happens to be 2 of my favorite stocks out there, and that's NVIDIA and Palantir here. And I got to, well, not me, but I got to spell Palantir correct there. But NVIDIA versus Palantir, that's going to be a fun matchup. Meta versus Alphabet, 2 of the Mag 7 fighting it out. Taiwan Semi, obviously the linchpin in the AI conversation versus Amazon. Broadcom versus Microsoft. I think
these are some genuinely tough decisions, right?
Listen, I don't.
These are not apples to oranges. These are apples to apples.
Yeah, I love a lot of these companies, but I'll tell you, this one's kind of the one where I would have a difficult time really breaking that down. I just have a lot of respect for both of those 2 companies. I have a lot of respect for all these companies. I'll tell you right now, if I had to pick an upset in round 2 on the AI bracket, I'm going to say Broadcom beats Microsoft on a bracket. I think NVIDIA probably beats Palantir, but I think it's going to be really close. Which one's your favorite of the matchups here?
And Nick had put on the cues.
That doesn't count. Please answer.
This is not like I am not a growth investor. This is not my
lose your disclaimers. We're playing a game. Come on, stop this nonsense.
Like, so what you want to know my favorite matchup?
I want you to answer the question without throwing in 14 disclaimers. That's what
the one I'm more curious about is NVIDIA versus Palantir. Who wins? Like, I will be voting for NVIDIA, but I'm curious just from that. My favorite stock in the whole bracket is Taiwan Semiconductor. That's who I will be voting for against anyone. I don't think they'll have the staying power, but that's who.
200-day moving average, though.
I mean, that's the one. If I had to invest in any of these companies right now, AI theme is not dead. who's at the heart of it. Intel's like 8,000 years away from producing anything. They're going to be at the center of the, I know for at least 3 years, probably 13, 15, 100 years. They're the one I can count
Taiwan's
on.
still there. Like there's plenty of room there.
Taiwan. So Taiwan's my favorite company in the bracket. I actually like where they're on the chart from an investing perspective too.
Awesome. All right, we got the dividend kings here. We got ExxonMobil beating 3M. Coca-Cola destroys Pepsi. Not close. Coca-Cola destroys. Not surprising to me. I called Energy Transfer beating Altria last week. They did. They destroyed them. Chevron came in over Archer Daniels. Nextera beat Bristol Myers. Realty Income beat Procter & Gamble. McDonald's, BlackRock, and Johnson here. Mark, what's your favorite round 2 matchup?
There's a lot of energy in the top part of the bracket. All that. My favorite matchups: Johnson & Johnson versus McDonald's.
That is a good matchup.
It's a good matchup. I will go Johnson & Johnson. McDonald's likely might win that. I don't think it's close from a who would I pick to invest in perspective. So like Johnson & Johnson is probably my favorite in the whole, remaining seeding. I just cannot get behind Energy right now. I think Energy will be all right, but I do not fight institutional powers. And Trump wants lower oil. And he will make deals with
wants to
Saudi.
drill a lot more oil too.
Yeah, well, and the Exxon CEO has said that doesn't really equate to profitability for his particular company.
Energy has not loved the last few month or so.
No. Yeah, and so deregulation aspects for energy are nice, but if Trump's going to make deals with the Saudis, who announced that they're going to be raising production, if he is going to remove sanctions on Russia, which is going to take, which is going to once again a negative aspect for oil. There's other companies in this bracket I would just rather invest in the next 2 to 3 years, and they're mostly on the bottom end of that bracket. But I like Johnson & Johnson the most in the whole bracket.
Yeah, the one that interests me the most is actually in the energy space, Energy Transfer versus Chevron.
I would vote Energy Transfer a million times over Chevron. Not even close.
Well, and I think Energy Transfer beats Chevron.
Yeah, I know. It's my second favorite company in the bracket because all of those negatives are things that don't impact midstream. Midstreams will benefit under Trump. Midstream companies, the transportation of oil,
and that's it.
Maybe not.
That's Energy Transfer.
And that's energy.
All right, so let's move on. Let's talk about the next bracket here. And the next bracket is on the right here, and that was the retail giants bracket. Mark, and we got Walmart obviously beating Dollar General. Target beat Best Buy. Nike beat GameStop. Tesla came in over Yum Brands. Starbucks beat TJ. Apple destroyed eBay, and Disney pulled off a slight upset of Lulu.
People don't like their yoga pants.
Round 2 matchups here.
And we're going to be talking retail a lot here in a second because most of the stocks in the news I have are retail companies.
A lot of retail companies reporting earnings right now. My favorite matchup is the 1-8 matchup, Walmart versus Target. I think that's
how's that the favorite? Walmart's going to win that by 80 points.
I know, that's why I'm interested in watching Target get destroyed. Tesla and Nike, I like that one's going to be really interesting to me, but I think Tesla wins. Apple versus Starbucks, I think Apple wins, but I wouldn't be surprised if Starbucks puts up a little bit of a fight. And Costco versus Disney. Disney's got their lovers, bro. They do. Disney's got their lovers, but I'm a Costco guy. So I like I'm gonna have to say Nike versus Tesla. That's an interesting one to me. All of these are interesting to me, but I think Walmart wins, Tesla wins, Apple wins, and Costco. That's what I think.
I will be voting for in this particular thing. Tesla, Walmart, Starbucks, and Disney.
Gotcha. All right. And then we got the hedge hunter bracket with all the commodities and things that are anti-dollar. No surprise, gold beats lithium there, 76-24. Copper with the utter destruction of real estate. The gold miners with an annihilation of palladium, pulling off the upset.
It wasn't an upset. It was a bad seeding.
Maybe. Maybe. I
It
did
was
the
a bad seeding.
I did the seeding and I got destroyed on that. I picked silver. 64% came in with uranium, though. Uranium's going to have to, they're up against the gold miners, though. The gold miners are loved at tackle trading. Platinum beat the tips in a 100-0. I think there was like 21 votes and they were all on platinum because I think a lot of people don't know what the tips are, and I think nobody cares about the tips. Oil versus Corteva. Both you and I voted for Corteva in that one. Neither one of us love oil right now.
Well, on the prediction podcast, I predicted oil at like $6 a barrel or something.
Like you're thinking negative 41 again. And then Bitcoin with the utter annihilation and utter destruction of Solana here, 92-8. Round 2 matchups. And by the way, all of these polls will be on our Tackle Trading Twitter account. And if you are not following us on our Tackle Trading Twitter account as of yet, let me pull that up and show you kind of where those polls are. Give me 1 second. So if you're not following us on our Twitter account here, you'll see we put all these polls here. You can vote in them all week long. We post the Tackle Today, many other things, and pretty good follow on the Tackle Trading Twitter account. So definitely check that out. Round 2 matchups here. Gold versus copper. Where are you going?
Gold.
Yeah, gold.
I really like, as far as most of these assets would beat everything else in every other bracket for me. Like
this bracket is not, this is your bracket.
Because as someone who thinks the market is heading material lower, I'd have copper versus any.
You get excited about the dividend bracket. I get bored. Like
there's 24 other companies in those other remaining things. I would have copper over every single one of them for the next 2 to 3 years. So yeah. So like this is like
now,
all of these
is actually FCX, just
and copper is one of my least favorite in this thing. Gold and the gold miners. I love uranium. I really like uranium. I'd have uranium over any of those others as well. But it's going to be hard to beat the stability of gold because it for me it feels like no matter what happens, gold's fine, right? Like gold's fine. Like and there are scenarios where gold does really well, and so. Give me gold miners, platinum.
Gold's got a high floor and a high ceiling, and that gives you a lot of confidence.
Yes. Yeah. So gold miners, platinum, and then Ethereum because I'm pissed off at Trump for his executive order on Bitcoin.
Listen, give that executive order a couple of days to digest. Sometimes we get too excited about breaking down everything. Just give that one a couple of days.
Nope, I have to make all my investing decisions right now, this very second, for all time and eternity.
That's right. Platinum Corteva. I think that one's actually a sneakily fun one a little bit. I'm going to go Corteva, gold miners, and Bitcoin. I'm looking forward to an Elite 8 matchup between gold and the gold miners. I'm looking forward to a finals matchup between gold and Bitcoin in this bracket. Now, I don't know if it's going to play out like that. Obviously,
I'm going to create 75,000 Twitter accounts so I can vote against Bitcoin.
Well, each week, like we said last week, guys, each week we're going to play one round of the Stock Madness game on our Tackle Trading Twitter account. This week we're going to start putting out these polls on Sunday through Thursday because we let the polls live out there for 2 days, and the poll has to get done before Mark and I start talking on Saturday so that we can update it. But every day we're going to put out polls on our Tackle Trading Twitter account, X account, and we're going to do the round of 32 next week. Going to be fun. I enjoy these things. I enjoy these things from a thought exercise perspective. I
do, sir. Genuinely, I became more bearish the more I study this.
So come have some fun with us on our Tackle Trading X account. That's it for the Stock Madness bracket update, though.
I'm going to fire through some retail. I got 2 semis, a Chinese stock, and some bunch of retail stores. Let's start with Broadcom, who had, I saw and it couldn't hold its bid. But the initial reaction, once again, I saw that initial reaction Thursday night, and I was like, we might be putting in a bottom. Couldn't hold his bid, right? Fighting for a bottom is the thing, but pretty decent numbers on that. And I like the price action here. I thought this was the most bullish chart I saw in the market because of the size of the company, because it was in the space that that is getting beat up, and then you finished near the top of the day. I thought, the raw numbers breaking down for us, but I thought this was the most bullish chart I saw in the market last week.
I honestly, I think specifically on Broadcom, but the nasty pricing on Thursday probably helped the pattern development here on Broadcom, quite frankly. I think the only reason they went down on their news was because of the overall market environment. Broadcom, I felt, had a really good report. Pulled off a hat trick. EPS beat by about 7%. Revenue was up really, really good. Increased forward-looking guidance. And what I said on in the lounge that day was, it's about stinking time we got an increase in guidance lately, because lately it's been guidance down, guidance down, guidance down, and now Broadcom comes out and says, no, we're actually good. We actually feel like this is going to be pretty good for us. And so I actually felt Broadcom had a really good report. One of the better reports of the week, in my estimation.
Yeah, no, I thought it was. I thought it was one of those, when you're paying attention for shifts in market sentiment, market trends, the end of a trend one way or another, short or intermediate. This one stood out to me. And so put that in the bullish case. I thought it was, and obviously, it stands out as an individual play. If you
It
get
does,
pattern
200-day moving average, and not only that, again, Todd's doing some updates, Mark, but this is an old pivot at 182, and so you have the 200-day moving average right there. It's an old pivot point, positive earnings report, held back because of market activity. Like this is on the short-term radar for pattern development.
I think so, and for investors that love the company, it's not a bad spot to be looking. Not a bad spot to be looking.
That earnings report did not get anybody off their. If you loved Broadcom, you were happy with the report.
Yeah. My next one, I was sticking the semi theme. Go to Marvel. It's funny how market sentiment can change so quickly. This felt to be a huge overreaction on minuscule guidance changes. But what did you see in the raw numbers, Matt? This felt like it was, and once again, tell me if I'm wrong. I may be wrong. You're the earnings expert. I don't even pretend to be. This felt like if it was a earnings report that happened, if the markets weren't selling off, you would have dojied or something.
It's an inline report. So positioning on the chart is going to be important on an inline report.
Mm-hmm.
If you're at a high price, you usually get those sold. You're at a low price, usually you see some stabilization. This was down 17% on the news, and you're an inline report. Now, officially, you missed EPS by 3%. You beat on revenue slightly, and forward guidance was mixed. But I believe the range, and I'm doing off the top of my head real quick, but I believe the range was like 86 to 76, and we were right there in the middle of the range. So a wide range was a concern. And the reason being is, if you're going to provide guidance, but you can't be specific on the range, and you have to widen the range, that shows us that you are concerned about the environment. Does that make sense?
You mean everybody loves clear messaging?
Yes. Messaging is an extremely important part of this equation. And yes, to your point, yes, we can be better on the messaging side of policy announcements. 100%, we can be better on that. We can be better on the crypto reserve announcement. 100%. If you plan this out and you message this appropriately, you don't create confusion for the next 24 hours. We can be better on the messaging side of the equation on the tariff conversation. We can be better on the messaging side of the efficiency conversation. All of that, yes. And it's here too in the marketplace, because MRVL was not efficient in their messaging to the investor class, and they sold that as a result. Now, I will tell you this. I think I had them on my bear quick hits because of the net result. Mark, when you have a semiconductor like MRVL, a growth name come out, miss EPS, and wide range guidance on reaffirming, it's not a food company. They're going to get sold in that. Growth companies got to grow. Growth companies got to grow. MRVL didn't do it. They got sold. I do agree with you. They got caught up in the market activity a little bit, but I'm not surprised they got sold on that report.
Next one, as a proud member of the Chinese Communist Party, JD.com.
They are.
I have been. I think I had the audacity on this, saying rather have China than U.S. stocks. Of course, I've said that at times when it was the stupidest thing to say in the world. This time, it happened to be right.
It happened to be right this time, though.
It happened to be right. I really like Chinese stock from a cash flow perspective. I like the themes, and so this just gave me an excuse to talk about China.
Well, I mean, JD came out with pretty decent reports. Beat on EPS, beat on revenue. Didn't provide like detailed guidance report, but like it was legit beats on the EPS and the revenue side of the equation. They tried to get up and go on a breakout and got caught up in some of the market activity on Friday and Thursday, but JD had a good report. I have no concern here on JD's side of it. I'm not looking chasing China at the top end of the trend, but like they got something brewing right now.
Yeah, no, I like the cash flow here. I do like pattern development that comes out. It's just it's anything. It's like when you've run too far, too fast, or whatever.
Yeah.
All that give me cash flow, but that gave me an excuse to talk about, to a red, white, and bluer, like pro China stance.
Yeah, I'll take my chance on the 200-day moving average.
Now, my next two are basically for Target, Abercrombie and Fitch, Best Buy, and Costco, because one of the big market stories this week we had a lot of retail earnings. Mm-hmm. We had a lot of negative price action across the board. We had a lot of similar stories coming out of different corporations talking about concerns on the consumer side, but more importantly, talking about concerns on the tariff side, how it was impacting their businesses already. We saw this out of Best Buy. We saw that, that was a big,
it was cookie cutter in the retail space last week.
Yeah, I mean, it was just basically you had an earnings report, you sold off, and the CEO was going to talk about how they're adjusting downward their guidance based on consumer and tariff factors.
And I kind of feel like some of these retail companies are using that as a little bit of an excuse for.
I was wondering that myself because of the uniform messaging coming out.
Yes, and when you have 300 companies in the S&P simultaneously have a very similar message on tariffs, I think they're trying to message something. But no, I felt Target. I think the market had it right on Target. Target lowered guidance. When you lower guidance, you're going to get punished, and Target got punished. I felt Target was one of the worst earnings report of the week.
Yeah, and just fire through Costco and Abercrombie A&F. I mean, it makes it tough. This is certainly not an area. Marvel, I could get talked into something that could put doing something on Broadcom or JD.com. It's going to be tough for me to want to get involved in retail, and I'm not interested in the bearish side because you've ran down a lot. I would need pattern development.
I'm interested in A&F on the bear side.
Just the clean support level break.
Clean $80 break. And A&F is one of those high flyers that went up a ton. And they went up a ton for a good reason, but now they're going down a ton because they keep lowering guidance. And so it just a nasty report out of A&F this week. And
well, I tell you, when the bears get a hold of a retail store, a consumer facing store, they own it.
It's punished.
Yeah. So yeah.
So I actually like A&F on pattern watch for a potential low base against that $80 breakdown level. Costco, now mind you, A&F and some of the other ones that we just talked about, like Target, those are just really bad reports, both dropping guidance, mixed reports on the top and bottom line numbers I didn't feel like Costco was a bad report. I just felt like Costco was held, they had been held up against some of the volatility. And when you're dealing with a week where retail's down for the most part on these earnings, Costco just kind of got caught up in all of that as well. You're actually at a pretty important trend line on Costco that you would like to see some development there, but obviously patience is going to be the name of the game here on Costco. But I thought Costco was a little bit different than A&F and Target. I thought A&F and Target were downright terrible reports. I didn't find Costco to be a terrible report, although the guidance was mixed.
All right. Let's get to Coach's Corner, finish out the podcast.
Got to be quick on Coach's Corner today.
Just and well, let's just do one, because all of the questions tie into the same general concept. Mm-hmm. So I'm going to do one that symbolizes basically a lot I had to choose from. My count is down. I'm thinking about buying puts on the Qs and SPY about 5 months out as a hedge. What do you think? Some version of this question.
I think you're on tilt.
Some version of this question came in. This was the problem. What do I do? My count's down. Should I buy puts as a hedge? Right now, we addressed that at the start of the podcast, but I would like to expand on it for 60 seconds. I'll just start. Yeah. I think when you move down 10% in the Qs in a straight line effectively, it is generally a terrible time tactically to do that. Yeah. Right? I think you have to look for better opportunities, because not only have you moved down, volatility is up. And so what you have to pay for that protection has skyrocketed, right? Like
the hurricane is in the Caribbean, and you are being offered to buy insurance on your property in Florida. The premiums are skyrocketing. Yes.
Yeah. Like at a minimum, and I don't even like this, I would do put spreads, because at least the bottom port is ironing out some of that. But I think one of those situations where if I'm tactically bullish, which I kind of am, at least in the short term, or at least stabilized,
I'm tactically bullish coming into this week because of battle and everything we've talked about.
I would use the move up to do that, or if you trade sideways and then break support, do that.
Listen,
it's too expensive and it feels too reactionary. Because it was the third highest put buying on the S&P 500. It was the highest put buying on the Qs, right? That is generally, the market doesn't generally reward that. That wasn't tactical. That was panic put buying. You want to find a way to not be part of that problem, right? And we can help you.
I always kind of feel this. First and foremost, I think if you're feeling the need to rush to buy insurance today, I think you're going to get a better price regardless of what the path of the market is in the future. Like legitimately, even if we continue to sell down here, I think you're going to get a better price on that retracement after it goes back up, or you're going to get
That's an excellent point.
I think you're going to get it anyway. So I think it's foolish to do it here. And that foolish is from a technical perspective. But I'll take it outside the technical perspective, because you don't want to buy a put option after a big move to the downside. You are getting sold that put option by a professional. I promise you that. What I'll say is this: when you think about the concept of insurance in the marketplace, think about that concept of insurance the same way you think about the concept of insurance in other aspects of your life. The market got gut punched over the last 2 weeks. It's down. It's getting smoked. It got beat up. All right. We all know that story. The ultimate question is, what do you expect to occur now?
That's it.
Do you expect it to continue to go down? What is your expectations now? You can't make a choice for today based on the emotional aspect of what you went through over the last couple of weeks. When you're thinking about insurance, think about it like a vehicle insurance, Mark. You don't go buy vehicle insurance after you get in a car wreck. You don't go buy market insurance after you got in a wreck. The market has got in a wreck. You don't go buy insurance. You wait. All right. And why do you wait? Because of volatility. That's why. And it's not going to cover the damage. So if you buy a put option today, it doesn't cover the damage that it did 2 weeks ago, Mark. It doesn't cover the damage a week ago. It's going to cover the damage in the future. And so you're paying a very high premium to cover damage in the future. Well, what are you breaking down? What damage are you breaking down? And so you got to have a logical reason for that. Think about it like hurricane insurance. Do you buy hurricane insurance before a hurricane hits or after a hurricane hits? It's before. When do you buy life insurance? Do you buy life insurance before you die or after you die? Okay, so the market got punched, and now you feel the need because of loss to go out there and rush to buy put options. I understand that emotional desire, but it's not going to fix the problem of last week. It's not going to fix the problem of 2 weeks ago. And so when you're looking at insurance, I would not buy insurance in an overextended condition against the backdrop of a marketplace that still looks like this one does on the longer term charts. You're still talking about some pretty elevated levels. And so I just think if you're concerned about the economy, if you're concerned about the marketplace, if you're concerned about your 401k, if you're concerned about your IRA or your retirement account, that is to be understood 100%. What I'm going to suggest, though, is always think about the future. Think about the current price today. Think about the future. You are paying a heavy price today to cover an emotional aspect of the last couple of weeks. I don't even think, Mark, that the need. See, to me, this is more behavioral analysis than anything. I don't think those questions are coming to you because they're thinking necessarily about the here and now or about the future. They're thinking about what they just experienced in the last week or two.
Yeah, it's so true.
And they're using that experience to impact their decision-making process for the future. And when we make emotional decisions, whether it's about love, lost, or money, it does not matter. We end up making terrible choices. And so what I would suggest is take a walk, remove yourself from the volatility, and allow the market to kind of figure out what's going to be that next movement down here, Mark. Because yes, does it feel like we're free falling here? Because we have been free falling here. But Mark, this volatility is nothing unlike that volatility back here. And if you were to rush to buy put options the last time we were at the 200-day moving average, not only would you have lost the previous 2 weeks, you lost the next 2 weeks too. And so think about what we said at the very beginning when we were looking at the case studies against the 200-day moving average. Both times resulted in higher prices. Now, does that guarantee that same result this time? No, but there is a pattern that we can rely on. And so what I would suggest, if that is your concern, there are better ways to do it. Number one, get your butt in a seat at Tackle Trading and get into Master Trader, get into the Trader's Lounge, and let's have those conversations in the real time. That's number one. Number two, it's always better to buy insurance with somebody else's money. It is always better to buy insurance with somebody else's money. So wait on that eventual move to the top side, and then write some covered calls on those long-term investments and take the cash flow. And instead of compounding that back into the stock, take some cash flow and buy put options. I think about Mark. I think about Mark Cuban sometimes when I have this conversation, Chucky. And I know we're late, and I know we got to go, but I'll be quick on this.
Oh, I've loved this. I'm recording this. I'm separating this. I'm sending this out.
In the 1990s, Mark Cuban had a company called Broadcast, and he sold it to Yahoo for like $6 billion, like $5.7 billion or something along those lines. I can't remember how much it was, but it was billions and billions of dollars. But it was billions of dollars worth of Yahoo stock in 1999 at like $90 a share. Okay. So Mark Cuban didn't own money. He owned an asset class that he could not sell because of the contract. Over the next 2 years, Yahoo went down to $13 a share, Mark. Cuban lost over 80% of what he made, what he had gained on the sale of Broadcast to Yahoo, except Cuban didn't lose any money. How? He sold call options, used the cash flow from the call options to buy put options. And as Yahoo went down, the put options exploded in value, and he didn't have to spend his own money on that. You want to talk about effective and efficient? That is effective and efficient. You want to be effective and efficient as a trader, as an investor, get into Tackle coaching and do this the right way. But that's how I wanted to talk about it. I think there's a right way to do things. There's a wrong way. The right way, wait on that rip, sell some covered calls, bring in that cash flow and park it into some put options. And that way you will reduce your emotional exposure to the market, because I would say your emotional risk in the market is as great as your money.
Oh, that's a great line. That's a good, man. That was fantastic. I'm literally going to cut that. I'm going to put that in a little safe place, send it out, because the wisdom you just dropped there applies to not just this particular moment, but will apply to a lot of different moments in the future. Education is powerful stuff. Matt, send us out. Talk about that education.
Yeah, I thoroughly enjoyed the podcast conversation here. If you love the podcast, best way to support the podcast, just give us a like and share. Let us help us get this message of the Trading Justice podcast in the eyes and the listeners of other people out there as well. Thank you so much for being the best part of Trading Justice and Tackle Trading. And if you are looking for an amazing community to call home, come over to Tackle Trading, start a free trial today of the Pro membership and get access to coaches shows, traders lounges, cash flow clubs. Those are all webinars we do every single week with our Pro membership. Get access to the Tackle Trading newsletter, the Traders Report with the picks of the coaches, the best technical setups every single week. That is what we do in the Pro membership every single week, and get access to that Master Trader class on the 24th and 25th later this month. Don't sleep on that. Sign up for that today and start taking this to the next level. Once again, thank you so much for listening to the podcast, for watching the podcast, and I hope everybody has a wonderful, wonderful rest of your week.